for the host to start the meeting.
All right. Good morning to the ARMR Macro Meeting, the very first ARMR Macro Meeting. I'm so excited for all of you to join us and for us to take the ARMR experience into this new direction. So you all saw the email and the post in Slack, so you have a general idea of what we're doing here and where we're headed. And without further ado, I'm going to turn you over to the captain, and I will be here in the background. I think all of you probably know how to use Zoom, but if you don't, on the bottom of the screen is a taskbar. Just put your cursor over it and you will see where is it? Where's the chat button on my screen? There are 3 horizontal dots on the right side of my screen. If you click that, you'll see the first thing you can choose is chat. I'll be monitoring the chat the whole time. So if you have questions to ask along the way, drop them in there and we'll circle back during the Q&A to hit every single one of them. After Bret has finished his opening remarks and the macro view and a little bit of the week in review that everyone's used to, then we're going to open the floor. This is going to be a very informal conference room research hedge fund conversation. So chat while Bret's talking if you have things to say and add, and then after that, bring your best ideas. And I will be here in the background, so if anyone needs anything, you can also through the chat directly message me for anything along the way. So Bret, take it away.
Brilliant, everybody. Thanks for coming. I just we're trying something new, and you guys are the first, and so I really appreciate you spending the time Saturday and doing this. I just, I've been spending so much time over the years talking at you, and really, I've always been curious what your thoughts are on a more real-time basis than just typing. So this is kind of, I thought once a month we would talk big picture macro, and then so the way I view this meeting is I'm going to just share with you some big picture thoughts on the macro opinion of what I think is happening in the market and where I'm taking ARMR portfolios and what I think I'll be doing next week. So we're going to do that. I want to focus real quick on cannabis. We created a graphic for you that I think says it all for me. And I talked about it Monday, but in case you guys missed it, I'm going to share this graphic and tell you really why I am definitely focused on a cannabis position in my portfolio. And then I want to open up the floor to really a conversations, anything you guys want to talk about. I know some of you are new insiders. And so I figure, hey, if you got questions about the ARMR report, anything about it, how to set a stop loss, anything you want to go over, any of the rules that I talk about that maybe during the week were a little confusing, just shout out, ask the question, and I'll walk you through as best I can. So it's a bit of everything on this meeting, and let's just jump in and have some fun and see where it takes us. So the first thing I want to say, I want to try to talk macro, right? So it's just big picture thoughts that are on my mind. Where we took the portfolio last week. We did something last week that I've struggled to do over the years running money, which is to take a portfolio from aggressively short to long in 24 hours, right? It's just emotionally very difficult for me to execute. But I want to thank all of you for being there with me. The more I explain it, the more I talk about it, the easier it is for me to execute. And so I appreciate you guys for that, for just being there and walking through. So let's just look at a couple of charts real quick to get the overall temperature of what we're doing in the market. And then I want to talk about what I think is going to happen next week and how I'm structuring the portfolio. So I'm going to share this screen as you're used to seeing me do. All right, so now you guys are seeing, correct me if I'm wrong, you're seeing a trade station chart of the S&P that I always start with. So, I guess what I want to start today with, since we shifted long, I know all the terrible things out there, and I know why, we're all afraid of the market and all that stuff. But I felt like the macro picture right now for me is trying to look around corners, as Hugh Henry says, say, where are we going next? It's not what we already know that's behind us. It's what's happening next and how do we position the portfolio. And when I look at this chart, which I've been looking at as totally negative, right? It's at a downtrend, head and shoulders top, all the things that we know. But all of a sudden, if we zoom in a little bit and we open up the picture a little bit, what you're starting to see is actually a head and shoulders bottom. And I know that's crazy. And so I'm trying to figure out, why are we seeing a head and shoulders bottom? If you don't know what I mean, let me just, I'm going to just use a rectangle as a way to show. So there's a shoulder, right? This is the head. So this is technical analysis 101, just how to build head and shoulders, right? So shoulder, head, these white things, right? These white rectangles. And then we're working on the next shoulder right here. So theoretically, if you break out of the neckline, and my guess is the neckline is the most recent high that we just shorted and made money on, right? That's the neckline right in here at, what is that, August 17th, okay? Because that's also the neckline of the original breakdown from a much bigger head and shoulders, right? Here's the head and shoulders breakdown. So I'm trying to figure out, why is the market doing that? Why is it doing that? Is it going to roll over and collapse? It might roll over and collapse, and we'll deal with that. And we have stops, we put positions on, and
Have your tenants recorded?
protect. But what's making the market look like that?
Okay.
And I want to
Hang
draw
on,
your
Brett, just a
attention-
moment. Brett, just a moment. Hey, everybody, if you would just mute yourself so that we can just hear Brett now. If you don't know how to do that, I'll pop in and take care of it for you. But on the bottom of your screen, on the left-hand side is a microphone. If you would just click on that, mute yourself.
We'll go for a run in the morning.
That would be great.
I'm the king of sexual harassment.
Okay.
There's so many.
Hey, Justin.
I'm in the car. Yeah. Exactly.
All right, hang on. I'm going to mute everybody.
There you go.
Yeah.
Great, Michelle. And why don't you run it like that? When someone wants to chat, we can take them off mute. Let's just do
Yeah.
that. That'd be great.
Yeah.
Okay.
Okay.
But so when someone's got something to say, how do we unmute them? Just
Well, I'll unmute everybody during the conversation portion of the meeting.
yeah,
So
I know, but what
you
I
all can feel free to do whatever you need to do. You're all
But do me-
muted for now. And then
but do me a
yeah.
favor, Michelle. Do me a
Mhm.
favor. If someone's got a question while I'm speaking right now, guys, put it into chat and Michelle will unmute you so you can ask it. Let's make this
Okay.
interactive, okay?
Okay.
So to
Fair
a
enough.
certain degree, I don't mind being interrupted about what I'm saying, right?
Okay.
Okay, so
Sounds
just
good.
put in chat, hey, I got a question. And then I could stop what I'm saying and address it, all right?
Okay.
So when I look at this chart, what I'm saying is, what's going on in the world? What's the macro story that's changing that I don't see right now, right? Because I'm real bearish. We know we've got problems in Europe, energy crisis, ongoing pandemic, strange supply chain issues and all of that. But that story, those stories are getting old to me. And the market discounts out in the future what's happening. It doesn't look behind us. I know there's an energy problem. I know there's supply chain issues. That's all, and I hate to say this hackneyed phrase, but that's all priced in, okay? I don't know if it's all priced in, but when the chart looks like that, I start to think that narrative is priced in. So what's happening next? And I'm going to take you through 3 charts that I think are just eye-opening to me, okay? You ready? All right, the ARC funds have been bottoming, okay, since May. Okay, ARC funds have been bottoming since May. That's ARC. Okay, look at ARC Genomic Revolution, right? How about ARKF? You can go through every ARC fund you want. These things are dead. The sell-off, which is in some cases like 80% off the highs, they're just done going down. The most so the assets that perform the best when we come out of an inflationary period, so we go back into deflation, when we get to the end of the Fed rate hike cycle and the Fed stops raising rates, the Fed doesn't even have to lower interest rates. They don't have to create quantitative easing. They can just stop being hawkish. They can pause. And the assets that respond the best in that environment are growth stocks. That's what really takes off. And so then I started looking at the ARMR power play names before I came on to chat with you. And I said, okay, what's Trade Desk been doing? Oh, trade desk ripped off the low. We already know that. What's Pinterest look like? You know, Pinterest is bottomed. The stock bottomed way back in, what was this? What is this? February? I mean, stock's been going sideways since February. And now it's starting to push out to new highs. Okay, we know the fundamental story there. It's a turnaround story, new CEO, all that. But I'm just talking about the macro picture right now. Why do these stocks look good? We look at Roblox. Okay, it's made its low in May, and it's been making an uptrend ever since. Let's take a look at the NASDAQ 100 now, because I could go through all of those charts, but let's look at the NASDAQ 100 for a minute.
Brett, hang on just a second. I have a question.
Yeah, go ahead.
When the questions come in, do you want me to interrupt you at that moment?
Yeah, sure. Yeah.
Okay, so Saber has a question.
Yeah.
This question is, how much do you think this is related to the November election? So the Fed narrative could switch to dovish for a while, then hawkish again after the election.
That's a great question. I don't believe any of that. Okay. I don't believe that the Fed makes policy to get people elected. That's just my opinion. I know that's out there. I know people say it. I don't believe it. I just don't believe it. Okay. So I don't factor that in. That's my first thought. My second thought is, Saber, I try to separate out questions that I can't possibly answer, right? Nobody knows if that's true or not. And so I can't run money worried about that. So all I can do is read and react to what I'm seeing. And when I start to see, what I'm trying to show you right now is the relationship between aggressive growth stocks and the NASDAQ 100. NASDAQ 100 made new lows in June. Aggressive growth stocks started making higher lows in May, right? May, June, July, August. So you're seeing a bottoming out in aggressive growth stocks. And I'm not even going to look. I don't want to look at them all right now, but I don't want to look at them all. There's tons of them, and you can go through a whole bunch of them. And so you're getting aggressive growth stocks that bottomed out before the market. These stocks lead the market. If you remember, the market peaked actually in early 2021. Look at this chart. And we talked about this then, but in early 2021, ARK, okay, just looking at ARK as the innovative stocks, February of 2021 was the peak in aggressive growth stocks. The big indexes didn't catch up until, almost a year later. They kept marching higher as aggressive growth got destroyed. Now big indexes have rolled over to catch up to aggressive growth. And so I'm trying to look at what's happening to aggressive growth. And what I see is it's starting to tell us, here's the caveat, right? If it craters next week and goes to new lows, this whole conversation's moot. Okay, aggressive growth goes to new lows, moot. But if we look at what's happening since May, aggressive growth is telling us that the bear market is probably close to over. Now, it doesn't mean the market has to skyrocket. I'm not saying this is a new bull phase, but it starts to explain why a bottom is forming in the market, the big indexes, if you look at the lead stocks. And so then I try to figure out why are these stocks going sideways to up? Is it because they're just washed out and they're down 80% and it's getting ridiculous? Or is there something else coming? And look, I'm going to be the first to tell you, because I was making fun of her for a while. I thought Cathie Wood was crazy, right? I mean, she's been saying some ridiculous things, and people have lost a lot of money. But Cathie Wood is singularly focused on a group. She's never said to anybody, go put all your money into ARK funds. She says, I'm going to offer ARK funds, and maybe this is 10% of your allocation. And you're going to do other things with the rest of your portfolio, right? It's going to suffer, but then it's going to come on and create alpha at the right times. It's your job and my job as the portfolio manager to figure out when we want to own ARK type of stocks, innovator stocks, and when we don't. So we've avoided most of the collapse of innovator stocks. And now what I'm saying is they're starting to do this. And so last week we started to put into our portfolio, we bought, really, I guess 6. Let's go take a look real quick, because this will wrap up this macro thought. And I want to chat with you on why do I think this is happening. So first of all, Tesla is like the poster child. Forget about the merits of Tesla and Elon Musk. It's just the poster child for innovative stocks. And it's clearly in an uptrend going back into May, right? So it made a higher low in May while the NASDAQ made a lower low, right? And now it's trading above all the key moving averages by the end of the week. And we're long Tesla in the portfolio. It's just a function of, this is the number one stock in the NASDAQ 100. If you view it from how it's performed, higher lows, higher highs, closing above every moving average, innovation is starting to lead the market. Take a look at these stocks. We already looked at
hang
trade.
on while you're
Yeah, what's up? Who's next?
Paul, I'm just going to actually interrupt Bret for a second on all of y'all's behalf. And Paul, I'll just tell you, you put something so interesting into the chat. Why don't you unmute yourself and express that idea, and then Bret can respond to it.
Yeah. What do you got for me, Paul?
Hi, how you doing?
Good, Paul. Nice to chat with you.
I said in my comment, what is new here is that for the first time in a long time, both innovator stocks and commodity stocks look bullish. And that's new. And what that suggests to me is that maybe we're not going to have a severe economic recession, and this is just an ordinary correction in a bull market. And both will now lead us out into the new phase of this market.
That's a good thought, and let's unpack that in a minute. I'm going to get there. I'm actually going to get there because I want to talk about commodities in a second. So, thank you for sharing that. Let me just wrap up this thought and then go in that direction. Okay. So just to run through these stocks. We already looked at Roblox. Let's look at Snow real quick. And you guys get the picture because you've been on the desk doing this. But look at Snow. Look at the uptrend in Snow going back to May, right? So just nice steady uptrend, and all these companies are just crushing it earnings wise, crushing it. So right through the collapse in the stock market, collapse in innovative stocks, total destruction. And I told you guys last week, I shared with you the epic vitriol. If you follow anything Kathy Wood says on Twitter, it's just insane. It's gotten to such a cacophonous level that innovative stocks are bottoming because of the insanity out there. Okay. That's just a sentiment thing. So I'm asking myself, what's really happening? So let's segue into commodities for a second, because I'm going to challenge you on that thought there, Paul, a little bit. I'm not sure that commodities are going to lead us out. I'm not convinced of that. Okay. And so I know I'm going to get pushback from Paul. I'm going to get pushback from Aris, and I want to hear what you guys think. Okay. I can't wait to hear the pushback. It's possible. This is the USO chart that energy's just touched the bottom of the uptrend. It holds here. It reverses. It goes back up. Totally possible. Okay. There's UNG. That looks like a totally failed pattern to me, but natural gas can always reverse and skyrocket. We've seen a lot of commodities, with the exception of gold and natural gas and energy. We've seen them collapse over the last few months. Lumber prices imploding, copper prices, whatever. I mean, things just collapsing. And I wonder if what we're seeing in the innovative stocks is that we're not going to get any type of significant inflation from here. We're looking at peak inflation right now. I don't know the answer to this, and I try to avoid these conversations on a day-to-day basis because our job is to read and react. But this is a macro meeting. So I'm just talking philosophically about what looks like is happening to me. I don't like building a portfolio. It makes me uncomfortable to build a portfolio based on two key, completely impossible theories for me to discount. There's a war in Eastern Europe, And there's like this ongoing rolling supply chain pandemic issue. Those stories seem so old to me, and the market looks forward. So I don't know what's going to happen in Eastern Europe. It could get worse. I don't know. I don't know what's going to happen with the pandemic. It could reemerge in the fall. But I'm looking at the market change, the behavior of the market change. I'm looking at innovative stocks leading, and I'm starting to think, Paul, that commodity prices are not going to skyrocket. I don't think we're going to have massive inflation. I don't think so. Could we have specific situations where gold and silver go up? I'm investing there. I got some silver plays on, and you can see why I put a little silver in the portfolio right at the end of the day on Friday, because I've been talking to you guys about it. Here's the double bottom, and I'm going to put some capital to work at silver and the double bottom. And if silver breaks out, I'm going to follow with some gold positions. But I don't have a lot of exposure there yet, but it's there. Okay. And I put a little bit of capital into SILJ, because look at that double bottom. And I'm pointing like this, but maybe you guys are seeing it right there. But classic double bottom in silver stocks. So look, there's unique situations, short and all this type of stuff. Maybe silver skyrockets. It all goes to this, right? It all goes to the strength of the dollar. So if the dollar rolls over here, and we looked at this chart earlier in the week. The dollar has been on an absolute tear. So theoretically, let's just walk this through. If the dollar breaks down in here, it makes commodity prices go up theoretically, right? There's so many different moving parts. But if the dollar breaks down from here, I'm paying more attention to the innovative stocks. So this chart here is very hard to understand. And I guess this is my last thought on the macro picture, and let's open it up and start chatting about other things. But a lot of this was my thought that's kind of bothering me. A lot of these forecasts, these conversations we're having, what we think is going to happen next, are based on historical references to what happens when A occurs and B occurs, then C occurs. But we have a completely different market right now based on a pandemic supply chain problem and some type of conflict going on in Eastern Europe. Some type, meaning I don't know if it's going to escalate, if it's just going to drag on for years. Who knows what's going to happen next? And it's totally distorted prices. For instance, the dollar's gone berserk because people are panicking, getting out of euros, what have you. Trying to predict what's going to happen to a commodity price in a world like this is almost impossible. So I'm just challenging my own thoughts. Do I think that energy stocks can go up? Yeah, I'm going to own drilling stocks because there's a reason that is not going to stop. I don't care what energy does for a couple of weeks or months. There needs to be drilling, and everybody has discovered that with what's going on in the world. Everybody's discovered it's been 10 years since we've drilled, and we have to drill. Era's put into the Slack room some updates from Schlumberger about how there's more drilling going on than even their rosy predictions in their last earnings announcement. Okay. So I'm willing to buy specific energy stocks, but do I think the price of energy, natural gas, and oil are going to skyrocket to new highs? I don't know. That's not what they look like to me. They might go sideways in here, and it'll be a fertile ground for drilling stocks, and energy stocks can go up on the next upswing. But, dramatically new highs in energy prices, you have to keep pressing the narrative of, war and unrest and all of these things driving energy prices. And it's getting tired to me. And when I look at the innovator stocks, I start to think something else is happening. And that thing is actually deflation 3 to 6 months from now, not inflation. I can't believe I just said that. But that's the thought I had for today. That's the big picture thought I had for today.
Bret,
I just
I'm
want to
going
challenge, looking at my
Oops.
notes here, I just want to challenge, lumber prices, copper prices, iron ore prices, a lot of these things collapsed recently. Here's another thought. A lot of these problems are supply chain issues, right? They're supply chain issues. But we've heard from many big box retailers. I'm not telling you guys something you don't know, but I'm just ordering my thinking. A lot of the big box retailers are telling us they have massive amounts of inventory. They're going to have to discount that to push it through the system. They're going to have to discount it, especially coming into the holiday season. So if we're seeing peak prices, we're going to see an absolute rip in innovative stocks. If we get to a point where, and this goes into what's going to happen next week. So how am I going to be trading next week? Next week is full of surprises. FOMC, OPEX, all of these types
Bret,
of things.
hang on just a minute,
Yeah.
if you would, just a moment.
Yeah.
Because I wanted to just, before you move on into what's going on next week, Noel, do you want to unmute yourself? Because you had an interesting comment that you put into chat.
Yeah.
Related to what Bret was saying. And so I just want to give Noel a chance to express that.
Guys, the purpose of this macro meeting is to share your thoughts. And I am totally welcome to you challenging my thinking. I literally want you to challenge my thinking. Why am I wrong? Why am I wrong that there's going to be deflation in 3 to 6 months? If you agree, that's great. But if you're sitting there thinking he's crazy, let me hear it. Why am I crazy? Go ahead.
On another technical note, as we move into this portion, there is a raise your hand option on the bottom of your screen. If you put your cursor over the taskbar, you'll see toward the right, there's a smiley face with a plus sign and the word reactions. If you click on that, you can, choose any reaction that you choose, but there's also a raise hand feature. So you can click that if you don't want to type everything into the chat, but you do have something that you want to express, feel free to do that. And I can still interrupt Bret at the appropriate moment. And
Michelle, let me just say this before Noel start speaking. I just want to, the purpose of this macro meeting, this is new. This is the first time we've done it. Okay. So you're used to hearing me talk and I'm used to just talking. Okay. But what I really want to try to do once a month like this is to share what I'm thinking. Here are the goalposts. Here's the picture. And then I want to hear your thoughts about it. It's not about who's right, who's wrong. This is just a conversation, because when you're talking macro, you really don't know. And so you're trying to discount possible scenarios. And then what we want to do is just read and react to what we're getting. So I'm throwing into the room today something totally different than most of us have been talking about for months. We're talking about pandemics and wars and asset price inflation. I mean, commodity price inflation. And so what I'm saying is, what if that's not what's going on? We got long last week. The innovators are breaking out. Deflation in 3 to 6 months. Have at it. That's my question. That's what I'm thinking. So go ahead, Noel.
Thanks, Brent. Longtime lurker, big fan, first time caller. Appreciate it here. I think I would say I really appreciate you kind of pivoting a little bit here, because, on one end, are we too far into a narrative, and believing a specific narrative that we're not reacting well, or I would have been short on Friday. Instead, I made money long. And so that was great. On the other side, I wonder how much of it is sort of this sideways action that happens, because we have a lot of FOMO going on. We have a lot of optimism, which is, wind on the back probably of the market. Maybe things have gone down too far, too fast, of course. And so we have some move up here, some move back maybe. But the overall macro, has the macro itself changed really or not? We haven't felt the effects of the rate hikes. ECB is now raising for the first time, ever, well, I don't know if it's ever, but I can
feels
remember,
like ever.
right? Yeah, and even the company I work for, a multi-conglomerate, very large top company, and going through layoffs, scale backs, budget tightening, and so inflation, they're still seeing supply chain issues, inflation's still there. You see it in the market, your car breaks down, you need a part, you still can't get it, you have to wait forever. Now, I know that the market is looking out 6 to 9 months, and we're hopeful that's all going to resolve, and maybe it will. But it's a question, I think, more of, are we preparing, still considering that macro, I guess, that it's still in a downtrend, that we still could have another leg down, and we're just playing an interim, pullback here, or, how are we really looking at this?
No, that's a good thought, but that's interesting. And what really struck me about what you just said is you work for a big conglomerate and they're laying people off. You're not alone in that, right? So the market's looking out 3 to 6 months, and we're going to start seeing unemployment go up. So the market is starting to say, because what you just said, I've read that about many different big companies that are laying people off and reducing workforce. That's a deflationary factor. It's 3 to 6 months from now. Then, so the market starts to see that, and they start to, this is what I was saying this week. It seems to me, feel free to correct me if I'm wrong, it just seems to me that over the last couple of weeks, maybe month or so, with the exception of the Jackson Hole meeting, every time a Fed voting or non-voting mouthpiece comes on and makes a comment about how hawkish they're going to be and they're going to raise rates and we're going to kill inflation, the market response, and you can see this because the market's in an uptrend now, the market response is less and less and less. Maybe it lasts for a day, the response. It used to last for a week. Now sometimes it lasts for 15 minutes. There's a comment from a voting member of how hawkish they're going to be. They're going to raise rates. The market goes down for 15 minutes, turns around and goes up. So, there is no answer to your question, obviously, right? We don't know if this is just a rally up in an overall bear market that'll roll over and implode. So how do I, so what, this kind of goes into what I'll be doing next week, Noel. I've set my portfolio up. Whenever the risk monitor goes from a red to a yellow or green color, I try to get all the capital I want to get to work on the long side to work within 24, 48 hours of the signal. The closest I am to the stop from a reward to risk. It just makes sense, right? I was saying to these guys last week, like, how is it a benefit to put more money to work next week when the market's up even more? You're just getting further and further away from the entry. So I try to get it all to work in the first 24, 48 hours. That means next week, what's going to happen next week is I'm going to be fighting a defensive action all week and managing success, which means if things rally up to targets, I'll book some profits. If nothing's rallying, I might be hedging intraday. So I don't know exactly. We can't answer your question. Is this the beginning of a new?
No, and it's not so much a question as just a comment, right? I mean, I think just being nimble, just as you were nimble this week and pivoting as needed. And so, I think as much as we can't be too negative, maybe we can't be too optimistic as well. And we just have to be, more nimble, I guess, and more attuned to the price action.
I'm with you guys. Just give me 2 seconds. Don't go away.
While Bret's attending to whatever he's attending to, let me just tell you, Andrew, I see your question. So that's next up. Erez, I see your hand. So you're coming after the answer to Andrew's question. So I just want you all to know I am watching and I am on it, making my list, and we will get through it. So I hope you all are enjoying this. Bret and I really love feedback. So anything that you think of going forward that would allow us to really up level the ARMR experience in ways that serve you better in a more deep way, a more meaningful way, feel free to shoot me an email or Slack me in any moment, because Bret and I are two creative beings and we love to have fun making things better. So, okay, Bret,
right.
Andrew has a question and Erez has his hand raised. So just telling you who's on deck, you tell me when you're ready for that next step.
All right, brilliant. So let me just say, just to wrap up that thought, you're absolutely right, Noel. We have to read and react. I've got my positions set up now. I'll be looking, like my primary trade for next week every day is I'm going to be looking to put on the hedge trade. So I'm looking to really short Qs and small caps against my whole long positions intraday if I see those setups occur. And I'll be walking you guys through it like we always do. But the number one setup that'll really get me to do that is if the market's up in the morning and VIX goes up with the market. That is a money trade on the short side. So it doesn't happen very often. I mean, really, unfortunately, it only happens like once a quarter, or it seems like that. But when it happens, there's no doubt I'll be putting on shorts to protect. And I'm going to try, to let the portfolio I structured last week, let's see what it can do from here. I have probably around a 30% cash position in the, when I talk about my portfolios, I manage many portfolios, but if I look at the portfolios in total, somewhere around 30% cash, and I'm not putting that money to work. So this answers a little bit your question. No, like I'm not over my skis on the long side. I've got cash and an S&P position. This is pretty conservative, right? And then I've got the rest of my portfolio geared towards what I think are asymmetrical opportunities, so that if we come out of this and it is bullish, these stocks are going to go to the moon. You know what I'm saying? So that's, and then if not, I'll be hedging the whole thing. So Andrew, what do you got for me?
Andrew, I see you're on headphones now, so you want to unmute yourself, or I can read the question that you put into the chat.
Yeah, you can read the question, Shell. Go ahead. Read the question for Andrew. That works.
All right. So Andrew's question is, why would there be deflation? There's a lot of money right now, but not a lot of goods, and that equals inflation.
Okay. So the market discounts the future. So what you're talking about, Andrew, that may be the case as we sit here right now. But what we're saying is something going to change that in 3 to 6 months? And if there's something that's going to change that, then the market starts to respond to it, and innovative stocks start to go up and growth stocks start to break out. Okay. And so what would change that? One thing that changes that is that the supply chain, it seems like a lot of these big box retailers have stuffed their channel with goods because they couldn't get goods. Okay. And so now they have too many goods. I mean, you've been reading about some stories where, I think it was Target, Walmart, Amazon, some of these places are allowing customers who don't want the product to keep the product. They say, don't bring it back because we don't have any place to put it. And now we're coming into holiday season. So how do they get all this product off the shelf? They discount it to get it off the shelf. So I'm just saying, I know that's the narrative right now. Supply chain issues and all these things. I get it. But what if it's not 3 to 6 months from now? And is that what the market's telling us? That's all I'm saying. It's just a theory that I have to examine, because I don't disagree with you, Andrew. That's what I see too. But let's just pretend, part of the problem is that China has been on lockdowns like constantly. What if they get to the point where they just stop locking down and all the factories open and they start pumping out product again? I don't know. We don't know what China's going to do, But anyway, so that's, I don't know if that answers the question, but I'm just, what you're saying and what you're seeing right now, I get. But what the market is looking to is what's out there. And I see major discounts going into holiday season. I see real estate prices coming down. I see, as Noel was saying, a lot of layoffs. So, 3 to 6 months from now, the Fed's not raising rates anymore. I don't know if the Fed's lowering rates, but they're going to be done raising rates, and they're going to be done with quantitative tightening. And they'll get to a point where they stop. And that'll be enough for the market to go up. Now, it might not make new highs, but the market could have a wonderfully tradable rally where we get alpha focusing on these asymmetrical opportunities, and it could be it's not that we're talking about a shift to a 2020, bull market risk monitor green skyrocket, because the Fed's not going to be adding liquidity. but everybody's priced in this horrific scenario of Fed increasing to the moon. And maybe that's not happening. Take a look at high yield bonds. I mean, high yield bonds, they made a higher low. They rallied off the low with equities, and I mean, if treasuries, we're watching treasuries closely because that looks like long-term treasuries are breaking down. But what happens if treasuries break to the upside next week? So what they're saying, what in essence treasuries will be saying is they're just trading in a range at this point. I don't know. These are all things to think about. Erez, what do you got for me?
And then Paul, you're up next after Erez.
Erez, you there, brother?
Hi, can you hear me?
Yes, good.
Well, I have to tell you, I'm with you, but I think it will be a short swing. At the S&P to the 200 days will make a double top and fail. The reason I think that is you are discounting what's happening in the world. Maybe in the US, you're right, but the energy crisis in Europe is much worse, and it's not going to be the same. And the way we used to be, like if the financial crisis is over, I think it will be much worse because, look, if you follow the war in Ukraine, the Russians have suffered some defeats lately. And the Russians are counting on the winter because this is their weapon, the energy. And I believe that the European, the wealthy, the rich countries will print money again. UK just started it, they kept the energy bills for the citizens, and the country will pay the rest. I think more rich countries will follow. There is a certain amount of LNG and oil in the world, and the rich countries will pay more and take it. I think it will, look, Argentina just declared that they want to join the BRIC. They have 95% inflation. Turkey, not so good. Brazil, not so good. So my guess is, and what I did last week when the energy stocks went down, as soon as I saw the turning back, I repositioned in most of them. And I think that your approach of riding this growth stocks, because they suffer so massive losses, I think it's true, but tight stops. And yeah, we will see what happens. I don't know. This is how I see things, but
yeah. No, I appreciate it. I want to hear. That's why I want to hear it. I want to hear it because I'm just, my experience, the only way to really be successful investing long term is to constantly challenge your own narrative. As Andy Grove, the CEO of Intel, wrote a book, and it was called Only the Paranoid Survive. And he's since passed away, but it's a really great book. He turned Intel around and turned it into the big stock that it was for a long time. So I follow that belief. Only the paranoid survive. And so when I get real comfortable with the narrative, it starts to concern me, So I don't disagree with you, but let's be honest. I mean, Argentina and Turkey, these countries are always perpetually dealing with massive inflation, it seems to me, right? I mean, historically speaking, Argentina has defaulted multiple times on its debt over the decades. So that I hear what you're saying, and I'm not a bear on energy. Like I get it, and I'm hoping energy holds that uptrend, right? But I'm just saying if it breaks down from the uptrend, what's going on? It'll be hard to understand. Hopefully it recovers, and I'm with you. I added, the drilling stocks back to the portfolio, and we still own in our, portfolio, the XOP, the XLE, and all of our pipelines. So I don't disagree with you. I'm just challenging my thinking there as I watch price action. That's all. You know what I mean? We'll see. Well, and of course, as always, I'm going to get tattooed on my arm, tight stops. Tight stops.
I think it's all about the dollar now. That's it. It's all about the dollar. The dollar is ripping higher, and this is what capping all commodities. But look, we still have the Biden, the green agenda in the United States. In Europe, they're still not changing their mind and their money where it flows. And if they want to continue building turbines and solar panels and whatever, they need commodities to do that.
Oh, for sure.
They need all of that. They need energy. If they want green energy, they need the old energy to do that.
No, you're right. And this gets to what Paul was saying about how we could get growth stocks going up and commodity stocks going through the roof. I don't disagree with you. It's particularly ones like lithium, right? I'm sitting here looking at the lithium stocks and I want to put my head through a wall. I can't believe I don't own them cheaper. It's just such a no-brainer. So
Bret, excuse me just for a second. Since you mentioned Paul, now would be a good time to unmute yourself and join this part of the conversation to add whatever you were thinking when you raised your hand.
Yeah, go for it, Paul.
Yeah, sure. I had a couple of thoughts. First of all, coming out of corrections or bear markets, cyclicals always do very well. So stocks like tech, FCX, steel stocks, drilling stocks, I would expect these to do very well if we are in fact coming out of a correction or bear market. And if you look at some of those charts like FCX, tech, SLX, I mean, they look to me quite bullish.
Yeah, and I don't disagree. And I think it goes back to what Erez was just saying about the dollar. And this is why I put these question marks up here. Can you all still see the charts? You can, right?
Yeah.
Yeah. So you're looking at UUP, which is the dollar, right? So if the dollar doesn't make it to the top of the channel, which it looks like it didn't, then that is the tip, just basic technical analysis. When you can't get to the top of a channel, it means the bulls are running out of steam and you're going to get a breakdown and it can get fairly aggressive. If that happens, I would just a little pushback, Paul. It's not that cyclicals don't go up, but at the beginning of a new bull run, innovative growth and tech stocks dramatically outperform cyclicals. I mean, cyclicals come on. It's not that they're not going to go up. So I wouldn't overweight my portfolio in cyclicals at the beginning of a bull run, if that's what we're at right now. A breakdown in the dollar, commodity stocks should skyrocket and growth stocks should go berserk. That's usually what happens. So,
well, I currently have like a barbell approach. I've got innovator stocks and commodity stocks.
I think that's the way to play it. And that's what my portfolio looks like too. I'm totally in agreement with you. Totally in agreement.
And the other comment I wanted to make is we should keep in mind that the next 9 months are the best 9 months of the 4-year presidential cycle.
Yeah. And so let's take that.
If you're bearish the next 9 months, you're betting against a lot of history.
Yeah, that's a great point. And that allow me to take a minute now, guys, and walk you through this graphic. This is a perfect time to talk about that, because if it's the best time in a presidential cycle, what you will see is an improvement, okay, in the approval rating of the president, okay? And if that happens, the single best place to have capital may be cannabis stocks. Take a look at this chart. Just for the fun of it, I put that together for you. So here's IBD presidential job approval rating. Now it looks god awful, right? Going back to 2021. And cannabis stocks look terrible going back to 2021. But look at June, July, and August. You're seeing Biden's approval rating go up. And look at what happened to MSOS at the same time. MSOS is starting to go up. So we started buying the calls, I don't know, a month ago. And we've got a position on MSOS that is about half the size I actually want to own. So if there's strength coming into next week and we get through next week and MSOS turns here, I'm going to be doubling that position. If it hits my stop, I'll get out. So that's, I don't think I have to say that to you guys. You get it. But taking a look at that chart right there, if Biden goes on this type of a job approval rating and we get to November and it's not a red wave, it doesn't even have to be a blue wave. If it's just not a red wave, I think that's just wildly bullish for cannabis stocks. I think it's throughout Biden's presidency and the ineptitude of Congress to pass any legislation when it came to cannabis, it just bottomed out those stocks. You know, there are very few people that are talking about cannabis as a long opportunity right now. They don't want to hear it. I mean, I've got friends and, you know, I've been following this cannabis story. You guys know this for, I don't know, 4+ years now. And I could just, from a sentiment point of view, I just get no engagement. You know, I mean, everyone's afraid of these stocks and forget it, they're dead. Okay. And so then we see the approval rating of the president go up for whatever ridiculous reasons. And all of a sudden MSOS follows and we get through the election. Now let's pretend, I call this a hedge on insanity for me. I don't want to get into politics, but the last thing I want to see in the United States of America is a Democratic president and a Democratic Congress. Okay. That's a disaster in my personal opinion. And I always think it's best in the United States of America to have whoever's in the president. I always like to see Congress be the opposite, because at least there's checks and balances and maybe they're going to come together and work together. And if not, nobody can screw it up too much. But when you get one party in control completely, it could be an absolute nightmare. And it would be like insanity for me to see, like, for instance, let's pretend it's a blue wave in November for reasons I can't even begin to come up with. I will be emotionally distraught from the standpoint of being an American, but I will make an obscene amount of money in cannabis stocks. And so that's why I'm putting on a position down here. To me, it's just a way to manage insanity so that when it comes to election night in November, I'm more even keel. So anyway, that's my thought on cannabis and something for you guys to consider. All right. Anybody got any other questions for me here? Let's just kick it around now. Oh, by the way, Aries, you said something about, you think it's going to be a double top. The market's going to run up to the highs of
Bret, hang on just a moment. I'm sorry to interrupt. You asked if anyone had a question.
Yeah.
Noel had submitted a question in the chat. MSOS is also following risk assets in general, right?
Yeah, totally. If you look at MSOS and the innovative stocks, for instance, they tend to kind of run together. They peaked at the same time. They're bottoming at the same time. They're all coming off of the lows. So yeah, that's another piece to it. But to me, the real surprise is that we wake up November 5th and we have a blue Congress. And, you know, I mean, that would just be unbelievable for these stocks. And I don't think anyone's expecting that. There's still, if you look at, you know, the different, I'm not expecting that, right? I don't think that's going to happen, but it's just a hedge on insanity for me. As long as it works. I mean, if it hits the stop, I'll get out. Okay. If the job approval rating collapses, what that really means is if the job approval rating of the president's going up, it makes it easier for Democrats to get elected in November. This is just, I'm giving you the, you know, generally accepted opinion, right? And if the job approval rating is going down, it makes it harder for Democrats to get elected. That's all. So if it keeps going up, you're getting an election cycle that's not as terrible, that can lead to reasonable people, perhaps, that agree on a cannabis plan. But if you get like Democrats to take over Congress, these stocks are wildly cheap. It's just ridiculous. And the last time that happened, you know, what was it, 2020? And these stocks went berserk to the upside. Now, of course, the Fed was adding liquidity and all that other stuff. But I don't need berserk. I just need a nice move off the bottom here, and I'm making some good coin. What was I gonna say though? Aris. Oh, Aris, I just wanted to go over. I totally agree with you. If you were to ask me what I think is going to happen, I think the market's going to rally by the end of this week. We're going to get past the Fed meeting. They're going to raise 75 or 100 basis points or whatever they do. Puts get sold because there won't be anything new that comes out. We already heard how bad it was at Jackson Hole. So theoretically, he's going to come out. He's going to say the same type of stuff. Maybe the market goes down when he's speaking, when he makes the announcement. And then by the time he's done speaking, the market recovers in a typical Fed day type of rally, which we've seen many times since we've been trading together. You get the initial reaction, down, hold, and then trades higher the rest of the day into the end of the week as options expire and people take off their puts because there's nothing new that comes out of the Fed meeting. Now, if the Fed says something like, we're raising 100 basis points and we're probably going to raise a whole bunch more going forward, because we think inflation is terrible, blah, blah, blah. If they get even more hawkish, the market could crater. But my guess is market rallies by the end of this week and makes its way towards the highs of last month. And it's at that point, Aris, that when we see any type of reversal, so I'm not going to just put a short on when it hits the highs, but I want to see what happens when it gets up there and it puts on a reversal pattern. By the end of that reversal day, I want to own index puts again. We did that the last time. It'll be even easier this time because we're long. So if the market runs up there, we're making a lot of money and we see a reversal pattern, I'm going to hedge my portfolio with index puts and I'm going to raise my stops on all my long positions. If the market keeps going up, I'll take my hedge off. My stops will follow. If the market breaks down, we have our hedge on and we get taken out of our long positions at a profit as the market double tops and craters again. That's my strategy. I hope we get a chance to execute that strategy.
Bret, how would you work this into your strategy? Paul asks in the chat, which way from here is the pain trade? He thinks the pain trade is higher.
I totally agree. That's exactly what I'm saying today. I think the pain trade's higher. What I saw a statistic of, I'm going to botch this statistic. I can't remember exactly. It didn't make sense to me. And maybe that's why I don't remember it exactly, but maybe you guys could correct me on the statistic, but something like hedge funds were short, like on an 8-to-1 basis, 8 short versus 1 long, like one of the largest short positions in history. Is that true? I think I saw that last week in a statistic I published on Twitter, and I can't remember. I wish I could share it with you guys right now, but there's just so much negativity that I think you're right, Paul. I think the fear trade is higher. That's right, and that's what the ARMR algo, the risk monitor is telling us. It just gave us a risk on opportunity on all of 5 of the 7 indexes we follow. So emotionally, I think the market should go down, and yet this is what's happening. So I think you're right.
Paul, go ahead, unmute yourself. Bret, just a moment. I think Paul has something else to add.
You still look like you're on mute to me, Paul.
While Paul is unmuting, and I can pop in and help you, Paul, I'll be there in just a second. Ken just put in the chat, Bret, that he saw the same thing, puts to calls being 8-to-1.
8-to-1, Ken. That's like a crazy figure. That's definitely why the pain trade is to the upside. What would the Fed have to say next week to get the market to crater?
Paul, you should be unmuted now. Sorry, Bret.
Now, versus what they're going to say, which everybody already knows, and then puts get covered or sold into Friday, which is why the market rallies. Go ahead.
One thing I like to look at when trying to assess if we're making a bottom is how is the sentiment on the next leg down different from the first leg down? And maybe it's just me, but the sentiment felt worse on this second leg down that retraced half of the first move down than the sentiment was on the first leg down. Like, I think there's more negativity now, or at least until 5 days ago, than there was in June.
Oh, no, I agree. I think that's reflected in the put call ratio, right? I mean, it's like off the chart.
Yeah,
Yeah.
yeah. I think we could be surprised by how high this could go.
Yeah, I don't disagree. And so I would always remind everybody in these conversations, this is not, we're having an interesting chat about macro. Macro is almost impossible to figure out. So I don't begin to be able to, and the timing of figuring out macro is like impossible. Even Hugh Hendry, whom I think is brilliant, and is now out of business, no longer a hedge fund manager, because he was always trying to see around the corner of macro, and he was always kind of more negative than positive. So that guy made a fortune in 2008. You know, his whole portfolio went up 50% the day Lehman Brothers went under. But I got off on a tangent there. I forget what I was going to say about Hugh, but shoot, I just forgot what I was going to say. But I'll tell you what, this was interesting. I was listening to his call this weekend, and he did a whole interview about volatility. And I wanted to share this with you guys because we've been talking about this on our desk, and it was just a brilliant interview that when he was done interviewing a hedge fund volatility guy. So all the guy does is run a hedge fund, $50 million in a volatility hedge fund. All he does is trade volatility. And at the end of the interview, the hedge fund manager threatened to sue him if he aired that interview on YouTube. So he had to redact the whole thing, and he just gave a snippet. He just let us hear his side because he took out the guy who he was interviewing, because he revealed the guy as a total charlatan. And it gets back to what we've discussed on VIX before, which is, why doesn't VIX go up right now? And the fact that VIX is really only an asset to make money when something happens that nobody can see coming, which makes it almost impossible to make money on VIX long. Hugh was saying he would never, ever own volatility assets, ever. And the reason is, he said, all these assets out there that people are buying are futures. They're volatility futures. If you want to try to protect yourself, you need to buy spot volatility, which is impossible, very hard to do, or impossible to do. All right. And he was showing how futures on volatility are as cheap as they've been, but spot futures are continuing to be elevated. And it was just, he totally eviscerated this particular hedge fund manager to the point that the guy was going to sue him if he put it out live. But it goes back to our conversations of the last few weeks, which is, if I'm going to be using VIX or VIXY or anything, I'd rather be short than long VIX. It's like a beautiful asset to short intraday. I don't want to hold any of it overnight. And like, there's just enormous gains on those things, shorting it. Trying to pick the 1 or 2 long days on VIX seems to me a total waste of time. And I think I've proved it, unfortunately, with my own trading portfolio. Anyway, Paul, anyone got a question? Paul, is your hand still raised or no?
I think.
Oh, no, sorry. I have to unraise it.
All right. I wanted to ask Erez, now that we've got you here, Erez, could you just give us a real brief synopsis of how you select a gas goat? You call them gas goats, the natural gas stocks that you've got. What are your top 4 or 5 names? And you can make this short. I'm not asking you for a long dissertation, but how do you determine it's a goat?
Okay. First, the usual, like you look at every company. You want to look at the management, you want to look at the cash flow, you want to look at the assets, you want to look at the hedges they have if it's an energy company. And then when I found out, me about the gas prices and the LNG, and putting stuff in the Slack room. And since the beginning of the year, I've been making a lot of money from these gas goats. If you look at the charts, and if you trade it correctly, I'm not saying I traded it perfectly. No one is perfect, and I could make a lot of money on some, and I could lose less money on some. But generally speaking, there have been, since the beginning of the year, a few rips that double the price or something like that, or 50 or 60 or whatever. Now, if you're looking at the macro problem of the natural gas, the problem is not enough natural gas in the world. The problem is the way you transfer it.
Wait, can I just say something?
Yeah.
I just want everyone to, one thing that a comment that Erez just made is very important when it comes to the gas goats. And that is how hedged their future is. So the stocks that performed the best at the beginning of this were less hedged. In other words, they hadn't sold it out in the future. So they're able to benefit faster from rising prices. And then as a company's hedge comes off, the stocks start to wake up. Wouldn't you agree, Erez? Like, so SWN, for instance, was hedged a lot in the beginning, and now that hedge is starting to roll off, and we should see that stock catch up a bit. Would you agree with that?
Because when they did the hedges, the natural gas prices around the world was cheap, and it's a contract. They can't like if you don't have a large part of your production hedged for the next few years, and most of energy companies, even the big ones, they use hedges because they need billions or hundreds of millions for each new investment or pipelines or facilities, whatever. It's very expensive. So this is a very critical criteria when you want to make the highest profit. All of them will go up, but some will go up much more than others.
Right. The ones that are less hedged. And to just finish that thought, what Erez is saying is, in order for them to have to increase their capex and drill more and find more, they need billions of dollars in cash to do it. And so what a lot of these companies will do is they'll sell their future production out in the future, get cash now, put it back into the business, try to find more reserves. And so they cap some of the rise in they cap some of their earnings explosion, right? Because they've sold it out into the future, and then natural gas prices skyrocket, and they don't see that jump to the bottom line because they've sold it in the future in order to produce more. And so when you're listening to conference calls of these companies, the ones that are unhedged, or the ones that say to you, our hedges are coming off over the next couple of months, those are the stocks you want to focus on. Go ahead, Erez.
And then when you filter all of this, the first steps, and then you go to location. Why? Because if I'm building of the arbitrage between the price of gas in the US and Europe and Asia, and I think it will be a long-lasting process, because even if the Germans and everybody now put billions in building facilities to import LNG, to transfer it to natural gas, they need the pipelines and then the facilities. Even if they put it a lot of effort, it's like 2 years if they really try to do it. And so you want to choose the companies that has access to the export facilities, or have contracts, because even if you find a gas field and you drill everything, now you need to move it from there. So if you need contracts with pipelines, you need the infrastructures, roads or pipelines that goes through there to move it. If you are in an area that is near the export facilities, if you are in an area where a lot of pipelines go through, if you have the right contracts, then it will be much easier for you to export all of your or most of your gas to make more money. So that's it. When it comes to that, you only get few names, like 5 or 6 names that checks all these boxes. And it's obvious for me, and you can see on the charts, they're performing the best.
Yeah. And so thank you for the work that you've done. And this is one reason why, once we had that badge created, we gifted you that badge, because you are a certified ARMR analyst. Like everything Erez just said, he's doing all the work for us. So when he puts into the room, these are the gas goats. These are why they're the gas goats. He's done the research, and we can just focus on our trading and our execution. And I appreciate the work you've done there, Erez. Any questions, Shell? It looks like.
Yes, you want, now might be a good time to stop sharing your screen if you're finished showing charts and graphics. And Andrew has his hand raised. So Andrew, I'm assuming you have a question or a comment to add. Why don't you go ahead and I'm right here, so I will unmute you. And you should be good to go.
I can't hear you, Andrew.
Andrew, you are unmuted, but we can't hear you. That might be a tech issue on your side.
While Andrew's working on that, let me just say we're in that stage here where we're just shooting out any questions you guys have to me. All right. So if you're a new ARMR insider and you're curious about something, you want to know anything, it could be about any issue. We don't have to be talking macro now. Anything that's on your mind. We're at that stage of this conversation. Andrew, perhaps you could write in.
He's typing it in.
Oh, good.
So while we're doing that, let me just take a moment to thank you all. This has been so terrific. And thank you all for helping us launch this new experience. We will be wrapping up by 1 o'clock, if not sooner. So if you do have any questions about anything or comments, this doesn't have to be a Q&A. This can be something you've been thinking that you want to share with the room, an idea that you have that you want feedback on, or that you just want to bring to everyone's attention. So this part of the ARMR Macro Meeting really can be a free-for-all, where if we were all in a conference room together and we sort of broke the meeting, but we were all just hanging around chatting, you might come up with all kinds of things that you share, and anything is fair game right now. So Andrew's question, Bret, do you see it as, do these hedges in the gas goat work like they do with restaurants and with wheat costs, where restaurants hedge rises in food costs with contracts? That's not really why the gas companies put out hedges. The gas companies need a lot of capital. Energy companies, any type of by the way, this happens in the precious metals space. It happens in copper companies. It happens with all commodity companies. If they want to, in many cases, increase their CapEx budget to drill more and find more, they have to, in many instances, borrow money from banks to do it. And the banks are the ones that make them sell into the future and say, okay, we'll let you borrow a bunch to go do what you got to do, but sell this percentage into the future and hedge. So it's really, it's a function. They do it so that they can continue the process of finding more reserves. I think that's normally why a lot of these commodity companies do it. And this is a really important factor when you're investing in commodity companies that I think most investors overlook. You'll see sometimes a commodity price skyrocket, and you'll go look at the stock and say, well, this stock should skyrocket because all they do is, mine this commodity, and the stock doesn't go up. And then you go do the research that Ares has already done for us, and you realize, oh, they hedge their entire production. I mean, I've seen precious metals companies do that. Price of gold and silver skyrocket, and the stocks don't go up. And then you find out that they've hedged out all of so they don't enjoy any of the rally in the price of the asset. Why do they do it? It creates a more, steady growth prospect for the company, because they can look forward, they can create capital expenditure budgets because they've raised cash from here to here. And it's a little more daring for a commodity company not to hedge, because then you're kind of at the whim of wildly swinging commodity prices. So it's not a bad thing that they hedge. It's only a bad thing in extreme markets when prices skyrocket and the company's hedged it out. Bret, hang on, because Andrew had a follow-up question based on that. He wrote, so it's a hedge on a drop of a price for an asset for the bank. What I'm saying is usually the banks make the energy or the exploration company do it. In other words, the bank, they take these exploration companies will either they'll float, they'll issue debt
okay? Or they'll borrow they'll borrow from the bank to go do an exploration. And the bank will say, okay, we'll lend you that money if you sell a certain amount of your production into the future to shore up your balance sheet. So it's not all based on hoping that the price of the asset goes up. It's like a business decision. And I'm not exactly sure your question there. I'm not saying that the bank, so the hedge on a drop of price for an asset for the bank. Yeah, I guess so. I guess that's what the bank is saying. The bank is saying, I'll lend you money, but I don't want to take the risk that energy prices drop to $50 a barrel and I just lent you a whole bunch of money. So sell some of that energy into the future and we'll come up with a level that we're comfortable with, and then I'll lend you the money. And it depends on the type of energy company, what they're trying to do. And the type of management team, how much they are when it comes to, are they big risk takers or do they try to manage their business a different way? It's not bank shenanigans. I'm not saying there's something wrong with the banks. It's a healthy thing that the banks make the mining company do. If you want to borrow a ton, you got to sell some of the right now in the futures market to make sure that you're not over leveraged and go bankrupt when the price implodes. So it's not a negative thing.
Bret, let's back up for just a moment. Gabe dropped into the chat that he missed the first half hour. And so his question is, are we essentially speculating for a Fed pivot in a few months that is starting a new bull run shortly, or are we speculating on a rally? So do you want to
if I had to, the short answer to that is, I don't know. And so at the beginning, we're speculating on a rally. If the rally keeps on going, then obviously we got on a new bull run and we didn't even know it. And that's usually how new bull runs start. You know, in 2020, the market crashed and the risk monitor went green on the 24th of March. And we bought a bunch of stocks. It was right in the middle of a pandemic. I was still spending an hour washing groceries before I brought them in the house. You know, I was bringing a bat to a Publix so I could get a roll of toilet paper. Okay. And yet we were putting a lot of money to work. And it turned out to be an unbelievable buying opportunity. The market skyrocketed. In that case, the Fed was adding liquidity. I get it. But my point is, I remember, do you remember? I remember putting the money to work. I felt sick about it. I felt like throwing up about it. I was like, this is crazy. I can't believe I'm putting money to work. It felt like the world was coming to an end. So we never know when we first put money to work what we're capturing. It's going to be one, I can guarantee this. It's going to be one of three things. Number one, we're going to get stopped out of all these positions next week, and we better be ready to protect our profits and our capital and not fall in love with our macro opinions, okay? Because we got to manage risk first. Number two, we're going to run right up to the previous highs and make a double top. And if you forced me, Gabe, to say what I think is going to happen, that's what I think is going to happen. But I don't know. Okay. Or number three, we're at the start of a new bull run because the market's starting to discount the fact that the Fed's close to being done raising interest rates, that the Fed's pretending to do quantitative tightening, but not really. You know, they were supposed to do quantitative tightening. And then I saw, it's always a month late. We saw that they added mortgage-backed securities to their balance sheet. I mean, what? They told us they were quantitatively tightening. How are they adding mortgage-backed securities to the balance sheet? So what the Fed says and what the Fed does, is a complete circus. And so we can't decide how to invest on what we think the Fed's going to do. We just have to read and react to what we're seeing. So we got an entry point. We put capital to work. If it hits our stops, we're out. If it runs up to targets, we book some profits. We raise stops. And if we get reversal patterns, I'm going to buy index puts to protect myself. And if the whole thing keeps skyrocketing, then, we got in at an unbelievable entry point. That's all I can say. And we better focus on reading and reacting now and get away from guessing what this is. Next question.
Bret, hang on. I'm going to start feeding you some questions that are pouring into the chat. We have 10 minutes. So this is the lightning round. Are you ready? All right. So Paul, I'm going to get back to your comment about uranium. I'm going to start with Ken's question. So is this debt shown on the books of the company, or does it appear as a line of credit? Does the hedge appear as an asset?
Oh, geez. Do you have an answer for that, Ayers? Have you taken a peek at the balance sheet and seen? I can't remember. It might be. I don't know the answer to that, Kevin. I got to go look again. I forget. I have to go look.
I'm not sure, but I think it is. It's shown on the books as I can't
Asset.
remember how they.
I think it's an asset.
Yeah, exactly. It's
I
like
think
an asset. It's like they have an asset and they put it for the bank for the loan.
Yeah,
Yeah.
Exactly. Yeah, I think it's an
Because
asset. If Silver Fox was here, he would answer that question because, he is
I'm
the
not
deep
sure, but I'm
dive
not 100%.
fundamental analyst.
Silver Fox is here, so maybe he'll drop that in the Slack room when he
Maybe he'll
composes
just
his thoughts.
Put it into chat if he wants.
or in the chat.
Where those hedges show up. I think it's a balance sheet item, I think. But so next question, Michelle.
Okay, next question. Forgive me, all I see is iPhone, so I don't know who this is. We have a couple iPhones in the chat and in the meeting today. So here's the question. 6 months ago, the Fed raising rates was kryptonite to tech stocks, even the leaders. Now, as rates go higher, innovators are going up. Is this because the ERs are still coming in strong regardless?
Yeah. I think it's because the market is a discount machine. It looks out 3 to 6 months. So, when the Fed starts to talk about tightening, nobody believes it. Then the Fed starts to tighten and everyone gets scared of it and they crush the stocks. Then the Fed starts like pushing on a string. They keep saying they're going to raise rates. We're going to do this, do that. And these stocks start to go up because, this is theory, right? This is theory. So please remember, whatever I say, the market reverses and craters next week. Okay, take this theory off and we'll talk about something else. But theoretically, these stocks start to go up because the market discounts the future and they see the end of the Fed rate hike cycle. Even if the Fed raises rates again, which they're going to do next week, and they talk about we might raise it one more time. Okay. If the market starts to see, as Noel was saying, we got a whole bunch of people being laid off from work. Hey, how about Andrew? Andrew's been telling us, Andrew works at FedEx. He's been telling us how much time off he has. Okay. I remember 6 months ago, he was working overtime and we never saw the guy. I mean, he was lifting everything he could lift. And now he's talking about, getting time off. The market is seeing an economic slowdown and begins to discount the fact that the Fed is not going to be able to raise rates aggressively going forward. And that's why the stocks start to go, the growth stocks start to recover is my guess. And on top of that, yes, the stocks that we're buying, Trade Desk, Roadblocks, Snowflake, I don't know. I wouldn't put Pinterest in that category because the earnings got wrecked, but Trade Desk, Snowflake, Roadblocks, these stocks are growing. These earnings and revenues are growing right through the downturn. So they're going to lead, I think, on the upside.
Okay, sliding right into the last 5 minutes. I'm going to read you a comment from Noel, and then I want you to wrap up with Paul's comment about uranium. You're a uranium guy sometimes.
Yeah,
so
and
that
let's
might
try
be
to rip through all the questions, Michelle. We can go a little over if there's any other question. I want to make sure we get to everything.
Okay. Noel just submitted this comment. My other concern is that the Fed and the administration handed out loads of money since the pandemic. This has held the market up during the inflationary period, but those savings are being eroded and won't be able to hold that support against inflation and raising rates.
That's a mouthful. That's a concern. The market breaks down, then that concern becomes more valid. That's all I can say. If the market continues to go up, that doesn't bother me, So put that on the ledger. I got a ledger here. Deflation and inflation worries, bull and bear market scenarios. I got it written down for me, and so, that could be. Moving on, Shell. I don't know if there's a question really for me to respond to.
No, it was just a comment
Yeah.
that
Yeah.
Noel was sharing. Paul's comment, CCJ has sold forward a lot of uranium, which is why I am not as bullish on it going forward versus other uraniums.
That's a great point. And I think what I've tried to do with my uranium positions, I don't own CCJ. That's why I took it all out and had to rethink. And that's a good point. I think CCJ can go up, but they've sold a lot forward. 60% of the production, correct me if I'm wrong, maybe the numbers changed, comes out of Kazakhstan. So I really want to focus my portfolio building on asymmetrical reward to risk. So when Erez gives us this idea last week, which was URG Energy, I would much rather have capital in URG. This is
Bret,
an exploration.
Did you just pull up a chart that you wanted to share? Go ahead and share the screen.
Yeah. So I would much rather URG, I would much rather own, because I think there's asymmetrical reward to risk in these smaller names that are doing exploration and production in the US, right? Because if prices skyrocket, and I'd rather own URNM, which I know has a little CCJ in it, but we have has Sprott Physical Uranium Trust in it, right? And these charts look really good to me here. Look like they're just breaking out now. So I would rather, I think you make a good point. I would rather own the smaller names that could be acquired by the bigger names as the price of uranium skyrockets. So totally with you on that. Next question.
Okay, next question. It might be kind of a comment from whoever iPhone is. If you want to put your name into the chat, I can personally recognize you. But the comment is, so if the Fed slows or stops raising rates because of unemployment concerns and there's a recovering in tech, would it be a short rally? And the comment just moved. Would it be a short rally and then down we go? Down we go, because the big picture would be a downturn. Why would it go up?
Because here's the fun thing that they don't teach you at university and in finance courses. Okay, the market goes, the growth stocks go up. The market starts to go up as you're going into a recession because it discounts what's going to happen going forward. Like the market's already down because of fears of recession. We already know we're in a recession, right? Government officials are lying to us about it. We're in a recession, right? So once it becomes official, you would think the market would go down on that, but it starts to go up on that because the market goes, if we condense all of this into a simple, if you said to me, what's the only thing I have to ever care about? I'd say it's just what the Fed's doing. Not what the Fed's saying. That's an interesting nuance. Not what the Fed's saying. What's the Fed actually doing? So if they come out and they talk hawkish and they raise interest rates, and then we see them adding to their mortgage-backed security purchases, market's bottoming because the Fed's still talking hawkish. They're raising rates. They want to keep inflation down. But let's be honest. If supply chain issues abate, and we already know the channel is stuffed with product. Walmart, Target, these big companies told us that they're going to have to discount dramatically to get off the shelf in the holiday season. And let's just say miraculously, the supply chain issues to a certain degree resolve themselves. I'm not even saying complete resolution. I'm just saying resolving from the horrific expectations that they tell you about on CNBC. If they resolve it all, we're going to get deflation, okay? And this is so growth stocks, tech stocks, they start going up way before the economy recovers. They start going up while the economy is going into and in a recession because they see what's going to happen going forward. That's usually how it works. And I'm just giving you, this is usually how it works. These are very bizarre times we're in, right? So a lot of what usually happens, and I would even say this to Paul, he mentions that this is the best 9-month period of a presidential cycle. I appreciate that information, Paul, but I also always remember with stuff like that, that's in the Stock Traders Almanac, okay? I need to pull out all of those presidential cycles when there was a war in Eastern Europe, Okay. When we have supply chain problems and a pandemic. So I don't really know that the next 9 months are going to be great, even though I know that statistic. I always worry about those statistics because they're static. They're not dynamic. You know, they're static. They look back, go through history and they say, oh, look at this. But I'm always, well, okay. Could you pull out the last time there was war in Eastern Europe and a major supply chain issue? Was that really the best 9 months of a presidential election? I don't know. Anyway, I mean, a presidential cycle. Go on, Shel. Keep moving. Don't let me talk too long.
No, that I think we have reached the end of everybody's questions.
Oh, great.
If there's any last idea that anyone wants to share or any final question you want to ask, now's the time. Otherwise, we will wrap this up. Andrew's adding the New York governor declaring a state of emergency over polio.
Which is in the water, I read. I mean, there's always something that's going to keep you afraid and out of the markets, you know. There's always something. I don't forget, the more horrific the stories are, you know, the more liquidity the Fed has to add to the system. So if there's actually a polio pandemic, what's going to happen is the Fed and the government's going to send a whole bunch of cash to everybody's house again. And the stock market's going to go through the roof as the Fed lowers interest rates. Hey guys, it was totally fun to do this today. I really appreciate you guys spending the time. This was great. We had a great turnout. I look forward to doing this every month with you. We're going to get on, we're going to have these conversations. It was fun to see half of Renal's head. There you are. It's nice to see you guys. It's like, there you are. Hey. Nice to see you, Renal. Nice to have you here. So everybody, and by the way, before we go, is there any quick questions that any new ARMR insiders have about the ARMR report and getting the information they need? Are you guys all up to speed on that? And if we don't discuss it right now, Michelle's an incredible source. You could send her direct messages in Twitter and she'll, or Slack, and she'll help you with that. You can always email me or direct message me. I want to make sure you guys are up to speed as soon as possible.
It looks like everybody has had a good time and is completely satisfied. So
Thanks for spending the morning with me, guys.
we are going to land this plane. Thank you all so much for being here, for engaging with us, which is really super fun to just be in real time with you and be able to really have a conversation. We'll see you Monday morning, bright and early, for the morning meeting at 8:30 and all day online in the Slack room. And of course, you know how to reach Bret or myself if you need anything in between and during the week. So have a great weekend, everyone. And thank you for helping us launch the all new ARMR Macro Meeting.
I love it. Thanks so much, guys. Take care.
Have a good day.